Notice how XLP was trading in this wedge pattern and it actually broke out and is now consolidating outside of that wedge pattern. I think what we're going to see in healthcare is actually, as long as you don't get a weekly close below this bar sitting at around the low is 129.20, as long as you hold this impulse green bar, this looks like it's poised and is probably going to make a breakout above this wedge pattern. And then just like the XLP, it's probably going to make a high, a nominal high, and then it's going to retrace back to the low end of the wedge, which would be your technical breakout of support. So if we just look at the XLV again, you can clearly see what I'm expecting is a breakout and then a retrace, and then you want to see and make sure that this particular area holds support. And again, the market, the overall indices, the Qs and the S&P can still trend lower even if healthcare goes up. So this is why the markets are so choppy, and you have to understand the market caps and the different sectors as to how they're weighted in the indices. And with the recent ramp up in communications and XLK technologies, you've really started to see weightings in the S&P and the Qs becoming more skewed to those technology names. Definitely showing heavier weightings in the indices, which means that if technology XLK sees downside and capital rotating outwards because it has such a significant weighting in the overall technology ETF, my apologies, I just got rid of the screen there. If you see more capital rotation out of tech and into some of these beaten down sectors, these sectors can still go higher even if the S&P is falling. But again, the S&P is certainly something you want to have as a tailwind instead of a headwind. Let's move along to the financials. XLF. XLF, nothing pretty about this chart. Bearish wedge setup is still on watch for a bigger technical breakdown to about this 28.15 level, maybe a pierce of 28 bucks where you would find your next big support. And you can see that that's still a fair distance away. We're talking about another potential drop and a very likelihood of a 13% move down in the financials. XLF, and this is probably going to be led on the back of regionals. We did hear Powell on Wednesday as when he was speaking on the panel at the economic forum there with, I believe it was Brainerd, saying that we're likely going to see more consolidation in the regional banks, and certainly it was very clear and evident to see a big technical breakdown on Friday as those comments were coming out. This is basically when Powell gave the 1-2 punch to regionals and the market as a whole, and he said you're likely going to see more consolidation in the regional banks, and the market did not take that well. An absolute big technical breakdown. On the intraday chart, this is the 10-minute chart of the regionals, but if you look at the weekly chart of regionals, you can clearly see, despite how oversold they are, you seem to have so much volume coming in, which indicates buying pressure and selling pressure, but it still just keeps making lower lows, and in a clear downtrend. Nothing really that I see that I would get interested in. Maybe, just maybe, if we saw a flush down to these COVID lows, because I know that's an extreme panic level, would I potentially go long? But you've almost hit the downside target that I had priced in, sitting at around 33.48. Potentially, there might be a couple individual names that I would maybe consider going long, but it's absolutely very, very detrimental that these regionals, you just don't know what lies beneath the surface, and that definitely should impact the overall financial sector as a whole, and that's what this bearish weekly wedge is showing us. And considering we've bounced off of this weekly 200 MA once, twice, here you got a couple week close below, had a little bit of bounce, so 3 times, 4 times. This level is very weak in nature, and it should be considered as minor support and definitely not anything major in nature. Let's look at the financial sectors on the monthly chart here. You can see that 18 stocks were up, 46 were down. A clear majority of stocks were down, and definitely showing the trend is likely continuing to the downside for financials here. Obviously, you did have some pockets of strength in Western Union, but even those banks that are showing signs of strength, like let's for instance pull up the WU chart, nothing really impressive. I mean, sure, you're having to move off the lows, but nothing impressive at all. And obviously, if you look at the middle of the pack here, you have weakness in Goldman, a major bank. JP Morgan also showing weakness despite indices moving higher. BlackRock, getting absolutely decimated. Bank of America, look how weak Bank of America is. This is a definite problem for the overall bank sector. And then Citigroup, I mean, oh my goodness, you know, Schwab, Raymond James, you have big heavy hitter names that are just getting absolutely demolished. And PayPal is another interesting one, you know. Definitely could see more weakness going forward if Bitcoin and crypto starts to collapse even more. So very, very interesting price action as we continue to transpire through this market. But nothing I'd be getting in front of as of yet on the financials. Definitely looking more on the short side of this sector because the probabilities do show a move lower coming to fruition. XLY is interesting because this is on watch for a technical breakout. You are at resistance, being the fact that you're under this weekly 200. But what's interesting about the sector is you are seeing consumer discretionary aspects break down. You know, you don't have to look far in the consumer discretionary sector. So let's go to consumer cyclicals here. So consumer discretionary is very, very important to pay attention to because it does track and monitor that consumer discretionary spending. And what I'm observing here, if you look at some of the important names on the monthly chart, you're starting to see some breakdowns. You know, Foot Locker was the most recent one. It had a massive gap down in earnings, basically got absolutely demolished, and it impacted Nike, it impacted other retailers. You're seeing Nike starting to lose performance. You know, Nike alone, although it's not the biggest in this particular sector, it's a major player in the economy, and it does show that people are maybe delaying these purchases that they were once doing maybe every 6 months buying a new pair of shoes, and now they could be only doing it every 12 months per se. But a potential M-top pattern, getting a bearish weekly close below this green bar. You are finding support at the weekly 50, but this chart is looking poised to move much, much lower. You know, I think you're going to test this weekly breakout bar before you get your next meaningful bounce. But considering Nike had this bullish check back off of support, this white trend line, you got your bounce. It looked like you were trying to break out, putting in more sideways bullish consolidation to move higher, and it got rejected and failed. That's a bullish pattern turned bearish. More downside is very, very likely to come for Nike, and that's something we have to pay attention to. And that's what's concerning about the XLY, is it's only being propped up by a handful of stocks, the likes of Amazon and Tesla, that have significant weightings that kind of skew this ETF. And if it wasn't for just a handful, I mean, again, we go back to the monthly chart of the consumer cyclicals. You have 42, majority of the stocks down, 23 of the stocks up, but yet it's still trying to break out. So you have the majority of this sector weak through the economy, but a handful of stocks are trying to break it out. That's a bearish divergence in my opinion. I never like to see that when it's not getting broad participation, especially when it's a clear breakdown in breadth of this ETF. Communications, let's take a look at XLC. Still one of the, or actually is the best performing sector over the last year-to-date period. Definitely outperforming most of the other sectors. It's up a whopping 30% over 30% since the start of the year, being led by Meta and Google alone. Also another sector on watch for this inverse, left shoulder, head, right shoulder, breakout on the weekly chart. You're stuck under the weekly 200 MA. Very similar price action to the XLY. Notice that both stuck under the weekly 200, right at the inverse and these wedge pattern breakouts. Now communications makes me skeptical once again, because let's pull up communications as a whole. Like I said, it's been a very, very strong sector. 9 stocks up, 7 stocks down. Google, Meta, comprising roughly just under 40% of the ETF's weighting, and the rest of them are clearly lagging. Now, it's interesting to see, Disney breaking down in the communications, because Disney is also a stock that holds a lot of macroeconomic power, a large American employer, very, very sensitive to tourist destinations and influx of tourists traveling. And it has a lot of that streaming aspect of the business model, the movies, the food, the themes and parks. So it has its hand in a lot of different macroeconomic sectors, and Disney's looking very bearish. Technical breakdown, you have this left shoulder, head, right shoulder. Downside of this move takes you to about 66. It's not going to get there in a straight line, and it's not saying that it's guaranteed to get there. But Disney's supposed to be a blue chip name, and it is, but the price action is looking like it could drop. I mean, the probabilities have opened after this bearish reversal off of earnings for Disney to probably have a very high probability that this could have a move down to another 27% drop. That is an astonishing move down in Disney, considering it's already been beaten down. Now, I would likely take an aggressive shot, especially if we move there in the next couple weeks down to the pre-COVID level, because that is a panic freak out level. But I would take probably a shot on the long side if you got a Pierce of 80 bucks, providing you didn't get any bearish consolidation off of this pattern. That's kind of what I'm looking at on Disney, but also another name showing a tremendous amount of weakness. And again, if it wasn't for Meta surging higher and continuing to push higher, this stock would likely, this ETF would likely be down. And what I'm seeing on Meta is this cool parallel channel. So you have this pivot high over here, pivot low, so resistance, support, then you bounced, hit the pivot high, then you rejected, hit the pivot low, and then you had your COVID. This was your COVID crash. You had your money printing, which basically took you right to the top of the channel, low rates. And then you had the excess 120 billion a month that was continuing for roughly, I think it was 16 months. So you had your consolidation at the top of the range, just outside that range. And then you had to break out of that range, had this huge move, euphoria move off of QE and low rates. And then you had a mean reversion back down to the low end of this range where you had your bearish consolidation. So notice this, bullish consolidation, bearish consolidation. Very symmetrical in nature, considering you had your big blow off move and then you had your big overshoot to the downside. And now all you've done is had another mean reversion back to that same resistance channel that's kept you in check over here, over here, over here, and over here. And this is a huge level for Meta. Most people think Meta is heading to this big breakdown gap, you know, sitting at around 323. I don't think so. I personally don't think. I think this is the big reversion event. And considering that we have higher rates now, considering we're not printing, I think this was the range where policy was pretty much kept inbound and intact before you had your big exuberant policy break to the upside. In fact, I still think Meta, now that you've hit the top of the range, maybe you get some consolidation here, but I think you could actually break much, much lower and retest probably back down to 200 bucks where you'll have some big support on Meta. But at this point in time, to me, Meta's at resistance, which should impact the communications from breaking out. And then you look at Google. So Google's an interesting chart as well because Google's a mega cap, massive multi-trillion-dollar valuation. Look what Google's hitting. It's pre-COVID trend. Okay, so your main COVID low over here, your big technical support breakdown, you've retraced now. Been rejected off that level right as of now. And then you look at the XLK, the same COVID trend line that's kept you in check, you're peaking above it. Now, what's the chances that XLK is going to rally through this if Google can't get through this? Now, obviously, if XLK is through its resistance channel, there's always a likelihood that Google is just trailing and could push up. But if Google starts to falter and can't get through its, you know, pre-COVID trend, then it's going to weigh on XLK, and it's also going to weigh in on XLC. So again, we have to watch these patterns closely because if these inverse head and shoulders are looking very beautiful, I will add that on the bullish side, but if these fail, watch out below because bullish patterns turn bearish lead to a much larger move to the downside. Now let's look at industrials XLI. XLI, I'm still seeing bearish inside bar consolidation on the intermediate time frame. The very short-term time frame, you have an initial move up and you have a little bit of an inside consolidation pattern inside this initial green candle high. As long as you don't take out that low, you have a potential to test the top end of the range, but the longer term intermediate and major trend is still looking like it wants to break this potential red bar lower. I still see this testing this double bottom range at 82.70. If we look at the industrial ETF as a whole, let's pull up industrials here. So over the last month period, industrials have held up really well. 31 stocks up, 27 down. Some couple key components. You're seeing UPS, a major leader, down. The war stocks, LMT down. General Dynamics down over the 1 month period. Deere is also an important reversal that just transpired on the daily chart. Not a healthy price action. When Deere has a double beat and then you see a big reversal of that nature on heavy volume off of double beat earnings, gap up and crack, that is bearish. You know, Deere is on watch for a triggering of this break of this key trend. This actually looks like a very opportunistic short, basically probably down to about 311. You know, even likely this double bottom zone. So Deere is an interesting one because it does have a heavier weighting and it is looking vulnerable to the downside. But again, there are pockets of strength, and you're seeing a divergence. You have American Airlines up, but then you look at Love Airlines down. So mixed price action in the airline stocks, the Jets ETF, is not something I like to see because it creates that unnecessary volatility where you could get chopped up. And again, it's more likely that if the S&P, how extended it is right now, if the S&P softens up in weeks, it's more likely that the strong names see more selling to catch up to the weak names, because the S&P has had an astonishing rally, and maybe if you see these weak names start to participate, the S&P can continue to push up. But some of the names in this names, Deere, 3M, which had a big insider selling, JBHT, another big insider sell this week, Caterpillar as well, starting to weaken and soften up. These are some names that were leading during basically the start of this year rally. So I pay attention to when stocks were the leaders and they become laggards, because that's a sign that the market is showing distribution signals. Let's move along to XLP. XLP has broken out, still holding above this key wedge pattern of support. That's the line in the sand you want to keep. If you are long, you have a weekly stock below this level. I'm actually looking to go long some consumer staples names. However, I want to see maybe at least 2 to 3 more sideways weeks of consolidation where we shake out some more sellers, shake out some more buyers, and we basically start consolidating here a little bit more. But I want to see this level hold, and then that is constructive to move a little bit higher. Staples are actually faring pretty well to move higher, but we have to remember we're still inside of this weekly hammer reversal, and that's a little bit of an issue for me to go long at this point in time without a little bit more consolidation. If you look at the staples, so consumer defensive on the monthly chart, 18 stocks down, 17 stocks up. Some clear weakness in some pretty important names: Tyson Foods, Estee Lauder, Target, Philip Morris, but then Monster, CHW, Dollar Tree, TAP, some of the beverage names are showing great strength. Obviously Clorox and Hershey are definitely showing signs of strength, but not all signs of strength coming across some of the important names like Costco just holding positive, Walmart turning negative. And these are some companies that have recently warned us about potentially softening sales and weaker guidance, especially Costco in recent nature has guided down a little bit. And that is a little bit concerning considering that most of their business is membership-based model, where they have generally cater to an income class that is not living paycheck to paycheck and satisfied and needs the so-called deals and lower priced items. But definitely pay attention to consumer staples, because I am interested in some of the individual names on more or less on the long side if we get more consolidation. Let's move along to utilities. So XLU looking poised to go lower. Moving on to utilities. Utilities, it's had a bullish pattern that has now failed. You got to close back inside the wedge. You lost this green bar breakout candle. This pattern's going to test double bottom in the very likelihood. The reason why utilities are so weak, simply if you look at the yield market, treasuries and interest rates have moved up significantly. Utility stocks are very defensive in nature and are very interest rate and yield sensitive stocks. We saw it in, when yields were basically rising during this period here, we saw stocks utilities get absolutely pummeled. Now we're starting to see yields rising again, and maybe utilities are in for another waterfall sell-off. And again, when utilities start selling off, it means people don't care about dividends. They're not moving capital defensive. They're actually moving their money into more of the risk assets to get a bigger yield, maybe perhaps because inflation is picking up as well. But one of the important reasons when you start seeing utilities break down and people flooding into the risk assets, it leaves people unexposed or exposed to the downside. And that's a problem, because people tend to be caught offside where they don't have those defensive names where they're still earning a dividend, and they kind of get caught with their pants down if there was a market sell-off to occur. If you look at real estate, XLRE also having a little bit of a cusp of a technical breakdown here to the downside, and that's something we have to be aware of, because again, it's one of more of those defensive sectors, and it was absolutely pummeled already. And if real estate starts to break down, specifically on the commercial and residential side, that's going to weigh in on a lot of countries' GDP, because real estate is definitely a huge component for most countries' GDP, especially in Canada, 21%, the States roughly 15%. So it's a massive employment indicator, and if real estate softens up, that certainly should spike employment. And if you look at the back end of utilities, which we didn't go over, on a monthly chart, 27 utility stocks down in the S&P, 0 up on a monthly chart. That is horrific. No participation in the utilities, which is very, very concerning. That's very rare to see all of the stocks in the sector down over a 1 month period. No outperformance, no relative strength, all relative weakness at this point in time. And considering that was a sector that was looking poised to move a little bit higher in the near term. And then you look at real estate. I mean, also 20 stocks down, 7 stocks up. Horrific performance. And then if we move along to the materials sector, XLB, you can clearly see XLB is making a series of lower highs and a couple series of higher lows. So creating this wedge pattern on the weekly chart. You are technically holding the weekly 50, which is a short-term positive. And notice how you tried dipping below outside of this lower boundary wedge pattern range, but the markets were able to hold and save the price action at that level. So with the assumption that the market makers saved this price action here inside of this green bar, you do have the ability to test the high end of the range. If the markets have a bullish move to the upside, you could even test the upper end of the range, but that's kind of your max level where you would need to see resistance. Being the fact that the intermediate trend is still inside of this red bar 2-week breakdown on a heavy volume basis, you do favor and have to lean a little bit more down. You have to favor the downside a little bit more probable. I still have it priced in that you have a little bit of intermediate support at the 200 and then more major support at this double bottom range. And if we look at the back end of materials, you can see on the monthly basis here, so over 1 month period, 11 stocks down, 5 stocks up. Never good to see, once again, the majority of the sector underperforming. And what's interesting about the materials is if you look at STLD, the steel stocks, Steel Dynamics, breaking down on a weekly chart. This is still one of the best performing stocks in the materials sector, and it is underperforming by a great degree. And you have to really take notice of those leaders that turn laggers. And in terms of its 1 year performance, it is still up 28%, outperforming, like I said, over the last 365 days compared to all of its peers. But on watch for a bigger technical breakdown, and steel stocks have an important overall, indication for the economy, because again, it could be indicating that maybe the manufacturing industry is slowing down, maybe the car manufacturing industry is slowing down. You look at who uses steel the most, and you have commercial buildings, some residential homes. Steel again is deeply enrooted in our overall economy, and when you start seeing steel breakdown, copper breakdown, you look back at FCX, a big copper stock, getting absolutely demolished this month, down 14%. Newmont, even a gold mining stock, getting creamed. Nucor, Steel, LYB, APD, a lot of weakness. You do have some strength in the lithium, in Vulcan Materials, but the majority is displaying weakness, which is never a good sign. Let's move along to XLE. XLE has also put in a potential break of a long-term trend line. I'm watching this trend line very closely. We pierced it here once, never confirmed, had a rally back to the upside, made a lower high in the trend. You can clearly see you hit your pivot range over there, and now you're trying to test the range break of this lower boundary once again, except this time notice the difference. There's more weakness below that level. Here you were down there for 1 week, had a positive close, recaptured the trend back in the second week. Here you've closed 1 week, made a lower weekly close the second week, tried to push back up on the third week, but still below that trend. So you are spending more time below this trend line before when you broke it over here. So that's definitely showing some relative weakness potentially creeping into XLE. And if you look at XLE, there's some capital rotation occurring. Over the last month, energy stocks have been hit hard. 20 stocks down, 3 stocks up. That is horrendous. I mean, you look at some of the big major stocks, Schlumberger down over 12%, then you have some strength in Range Resources and EQT in the last month. So you're starting to see some money rotating into some of the natural gas plays and coming out of the actual oil plays. And if we see oil break down, it's going to wane on this energy sector. And believe it or not, if you get another weekly confirmation break below this pivot, you have a downside target of about 54.50 over here on the trend. You can see a massive breakout zone over here, consolidation, 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 major pivot, breakdown before code, big technical support there. I would absolutely be going along with both hands if XLE was to flush down to there. And pay attention, because XLE was with that leading sector in 2022, and now it's gone negative over the last 365-day period. And again, energy is very sensitive to overall macroeconomic trends from near and far abroad. all over the world, and we have to be mindful of that, and that's never a good sign. When you start to see, Chevron breaking down, Schlumberger, Defensive, Marathon Petroleum was the best performing energy stock in the XLE. I think we touched base on that a few weeks ago in our energy update, and now it's starting to slip. It's only the third best performing, still holding up about 15%, over the last 365 days. Hess and XOM Mobile are still the two outperformers in the overall energy sector at this point in time. But even XOM is starting to show some weakness, and Hess over the last month. And if those continue to break down, those are some heavily weighted names that definitely weigh on the S&P and this XLE sector as a whole. On that note, thank you all for tuning in. I am in the process of relocating over the next month and a half to a new property and a new studio. We're renovating and making some changes here, so my videos are going to be a little bit different, a little bit shorter. I'm going to try to make it work for the most part, but definitely going to be in a little bit of a new routine as we upgrade the studio and prepare for a wild quarter 3 and quarter 4 for these markets. But I'll try to keep my members and subscribers, definitely my members, abreast of all the bigger macroeconomic changes. And as for subscribers, they may get a little bit of less material moving forward, but definitely I will try to post videos that I think are necessary and beneficial for the overall, knowledge of the market and where the trends are likely to head. So to sum things up, again, if I was to go long a sector, XLV individual names are looking a little more poised to move higher. I'm thinking XLK technology is going to see capital rotate outwards into the healthcare sector. I'm also thinking staples look constructive to move higher if you see more consolidation. I'm seeing utilities having a big technical breakdown that is likely on watch for a bigger move to the downside, which could be potentially shorted. But again, weakness in energy, watching that closely as well. But there's really not too much I'm liking other than healthcare and staples, and very, very particular about those long entries if I were to pick them. On that note, thank you all for tuning in. Please give this video a big like down below, and we will see you on the charts sometime soon.